This is the study session on financial reporting and analysis and the reading on inventories. We've talked about inventories in a previous reading, specifically in the reading on the balance sheet. What do we remember about inventory? It's a current asset. When the inventory is sold, there's a recording of a revenue, and it generates either cash or an accounts receivable. Doesn't sound very exciting. But let me try to convince you during this slide deck that it's at least interesting. And inventory valuation is interesting from the standpoint that the selection of the valuation method will influence things like profitability and tax liability and ending inventory balances and probably financial ratios. And maybe I can even convince you that there's some fascinating stuff about inventories and their valuation from the perspective of the financial analyst who is trying to compare and contrast the performance of companies, and that's going to include companies who use different valuation methods. First LOS asks us to distinguish between costs of inventories and costs recognized as expenses. And so before I get into the details of this LOS, let me just have you envision in your mind a giant motorcycle factory. I live near one of the Harley-Davidson plants. I want you to think about the building. I want you to think about the metal stamping machines inside of the building. And I want you to think of going from, all of these individual parts, whether it's the tire, whether it's the wheel, whether it's the gas tank, whether it's the handlebars. And so they manufacture all these things and they put them together in the process of completing the finished good. The question becomes, which costs should be included as an inventory and which costs should be excluded as part of inventory and then recognized as an expense? Well, clearly things like the cost of the handlebars, the metal, maybe the rubber, clearly those things should be included, even the wages of the production workers. And so some good examples are purchase price and maybe import and tax-related duties. That's a big thing here in the United States these days. Transport and handling costs. And then you've got to be considerate of trade discounts and rebates and similar items that will affect the purchase price. But remember to include things like the cost of conversion and then maybe other costs that bring the inventories to its present condition and location. All right, so that makes sense, those things that ought to be included in the value of inventory. But then what should be excluded? And there's a series of these. And this is important here. Of course, all administrative overhead and selling costs. Think about that big building that I was talking about on the previous slide. Clearly, we're not going to include the electricity and the salaries and the air conditioning, et cetera, right? Storage costs, when we put the motorcycles in the back waiting for them to go on the airplane or the truck to be delivered throughout the country or the world. But there are some abnormal costs, and I always think about these as spoilage or waste. If for some reason a tire comes off the assembly line and it has a big slice in it, well, that's a material waste, and so that's probably just going to get thrown out or maybe kind of retooled. But abnormal costs would be something that maybe shuts down the production line for an extended time period. Those costs are treated as an expense, and they go right to the income statement rather than going on the balance sheet as part of the current asset. All right, here's probably the most important among the most important LOSs in this reading is to describe, and then later on we'll do some calculations about the different inventory valuation methods. Now, the International Board and the U.S. Board, they pretty much think alike with one exception. And so both the IFRS and U.S. GAAP agree that firms can use specific identification or the weighted average cost or the first in, first out. But in the United States, LIFO is also recognized. And so that fourth number over on the bottom right-hand side of the slide, that's going to cause us some interesting implications, and we're going to address those in some LOSs as we get through the slide deck. Let's work through these just from an accounting theory standpoint. So specific identification, this is used for inventory items that are typically not interchangeable. If we're a golf ball manufacturer, we're not going to use specific identification because, after all, aren't we manufacturing, I don't know, hundreds of thousands, maybe millions of golf balls? What's the difference between the two? We don't really know. But this specific identification valuation method is for items that are typically expensive and typically unique, like rare gems. I always think of the Pink Panther diamond from those old Pink Panther movies. Automobiles, we have that vehicle identification number here in the United States that identifies a specific automobile. Motorcycles are probably the same thing. Those of you who've watched my videos before will know that I've given several James Bond references. Sean Connery wore a Rolex in the first movie, and then Daniel Craig has worn an Omega watch in the recent movie. So it makes sense then to have a specific identification. So, hey, that James Bond watch cost us, $9,500 to make, and we can sell it for $20,000 or whatever that price is. Now, the weighted average cost method tries to remove the fluctuations of the input prices during the production process and just takes an average. And so the weighted average cost is really just going to be a simple ratio of total cost of goods available for sale in the numerator, and then divided by those total units that are available for sale. Now, here's the big difference among the four methods that we're going to look at: FIFO and LIFO. First in and first out is recognized both internationally and the United States, whereas LIFO is permitted only under U.S. generally accepted accounting principles. What FIFO does is the following. It assumes that the first units included in inventory are those units are the first ones to be sold. Last in, first out is just the opposite. The last units included in inventory are assumed to be the first ones that are sold. Now, your first thought ought to be, do I really care about this stuff, Jim? And the answer is yes, you do, if prices change during the course of a time period. And this is what we know, prices are never fixed. And so input prices, they change. So we can have rising prices or falling prices. And these two methods are going to come up with potentially very different valuation amounts. So the cost of sales reflects the cost of the beginning inventory plus the cost of those items purchased earliest in the accounting period, whereas LIFO, these are more recently. And so the first thing that you should be thinking of is that, okay, with LIFO, if they're the last in and the first out, so it's the last one in. So I just made one this morning and then I sell it this afternoon. What that means is that the cost of goods sold is matched with the revenue on the same day or nearly that same time period. And then the value of ending inventory is going to be just the opposite. So with FIFO, the ending inventory reflects the cost of goods purchased more recently, where under LIFO, the ending inventory is the cost of older goods. And you should be thinking along the following lines that, boy, if there are substantial differences in prices from the beginning of the period to the end of the period, then these two methods might in fact arrive at very different inventory valuations. And that would be good thinking. And here's what I just said. So in periods of rising prices, the costs assigned to units of ending inventory are higher under FIFO and lower under LIFO. And then just the opposite for declining prices. And we'll see that in an example. And here's the example. So I'll give you a second just to kind of look at this. We're going from March 1st to March 29th. We start with some beginning inventory at a specific cost, and then we add to the inventory throughout the month at different costs. So this is what you ought to notice, that beginning inventory was around $51, let's say, but then we made another purchase of around $56, and then another purchase at $60, another purchase at $62. So our input prices are rising, and then we sell some at 85, and then we sell some more at 95, and so we've got 530 units available for sale, and then we sold 370 of those units. And so the question then becomes, okay, let's go ahead and value these according to those important and different inventory valuation methods. And we're going to have to be concerned about whether we use the perpetual model or the periodic model. And we're going to see that sometimes they're identical and sometimes they're not. Most of the times they're not. But think of it this way. The periodic inventory system assumes that inventory is valued at discrete intervals during the time period. In other words, when somebody goes out and looks in the back and says, okay, we have 12 bottles of pickles here on December 21st, or whatever that date is. The perpetual inventory system is exactly what the name suggests. It assumes that inventory is accumulated and sold continuously throughout the month. And so there are going to be some minor differences between those two. So let's first start with FIFO. All right, so let's toggle back and forth here. I hope I don't get you guys dizzy by doing the toggling. But with FIFO, what we're assuming is that the first units in are the first units out. All right, so look at the bottom right. We sold 370. So in general here, now I don't want to do mathematics just yet. In general, those first units, the 90 from March 1st, the 220 from March 5th, the 80 from March 18th, those are going to be the first ones in, so then the first ones sold. So the question then becomes, how do we value those? So let's go ahead and value those. But first, let's do the sales. So this is an easy calculation that will be constant throughout any valuation method, right? So we sold 250 at 85.80, and we sold 120 at 95.80. So, whoops, I went the wrong way. So there's the 250 times 85.80 plus 120 times 90. So our sales is 32,946. All right, nothing too interesting about that. That's just total sales. But how about the cost of sales? All right, so notice what's happening here. We sold 250 on March 9th. And so what we did is we assumed using FIFO that we sold all of those 90 units. All right, so watch this. Look at that. So 90 units at the $50.80. So that's our first layer of inventory that goes out. And then we're going to sell, well, we didn't sell all 220 on March 5th because we only sold 250. So all we really need is another 160. All right, so notice I've got the 90 units times $50.80 plus the 250 minus the 90. That gets me, what does that get me? 160. So there's my cost of sales for the March 9th sale, 13,500. And then we do the same thing for the March 29th sale. We sold 120 units. So we're going to have to go back and sell those unused portions of the 220 at the 55.80, and then the 80 units, and then maybe some of those 140 units. And so that's what we do on March 29th, right? We sell those unsold 60 units back at the 55.80, plus 60 of those units at the $60.80. And so the March 29th sale gets us $69.96 worth of a cost of goods sold. So if you add the $13,500 and the $69.96, you get $20,496. And subtracting that from the sales gets a gross profit of $12,450. Have I convinced you that this is at least interesting yet? Okay. All right, how about ending inventory? Let me just toggle back here. What do we have in the ending inventory? Boy, we have a bunch of those units at 62.80, right? Because those weren't sold. And so what do we know? We know that that 140 were not sold at 62.80, and then 20 were not sold. Let me go back here. 20 out of that 80 were not sold at 60.80. So that gets us ending inventory of $10,008. And note under FIFO, this is a good thing to remember, that the results under the perpetual and the periodic methods for all categories are going to be the same. And that's true because with first in and first out, it doesn't matter whether you make the continuous assumption or the discrete assumption. Those first ones out are the first ones out. How's that for a profound statement? Now what I did was I copied this table with all the activities so I could just toggle back and forth between LIFO and the table. All right, so let's do a big picture thing just like we did a few moments ago with LIFO. Remember, these are the last in and the first out. So we've sold 370 units. And so what we're going to do is assume that those 140 on March 25th were sold, then the 80 on March 18th were sold, and then the 220 on March 5th were sold. So we're working backwards. Last in are the first out. Now we're going to have to pay a little bit of close attention with the difference between the perpetual and the periodic inventory systems, but essentially we're just working backwards. All right, so I think it's easiest just to look at the periodic first, right? So let's go back and do this quickly under the periodic method. We're going to do, we sold 370, so 140 of them is sold on March 25th. And then 80 of them are sold on March 18th. So that gets us up to 220, right? So we need 150 of those 220 units on March 5th. All right, so under periodic, we got the 140 at 62.80, and then the 80 at 60.80, and then the 150 at 55.80. That gives us a periodic cost of sales of $22,026. Now for perpetual, we're going to have to pay attention to a couple of things that are going on here, right? So watch this. On that March 9th sale, we're going to sell all of those 220. All right, so I will go back. We're going to sell all of those 220 at the 55.80. And then we're going to sell 30 of those 90 at the $50.80. All right? So notice under perpetual, I got the 220 times 55.80 and then the 30 times 50.80. And that completes the sale on March 9th. So those 60 units that were unsold, they're going to still be unsold because then we're now replacing our inventory. So we buy another 80 and then we buy another 140. And then on March 29th, we sell 120 units. So of those 140 at 62.80, 120, those were the last in. So those are going to be the first out. So we're going to add, so notice what I've got there. Let me just remind you, 220 at 55.80, then 30 at 50.80, and then the 120 at 62.80 gives me $21,336. And then to get gross profit, subtract those two costs of sales under perpetual and periodic from the same $32,946 of sales that will compute under all of the methods. And that gives us gross profits of $11,610 and $10,920. And then the ending inventory is going to be, well, just what's left over. And so under that periodic method, we have those 90 units, right? Let me go back here. Those 90 units at the 580, at 90 units at the 5080, they're part of our ending inventory, plus the what's left over that we hadn't sold, that's going to be 70 units at the 55.80. Let me go back right there. 70 units at the 55.80s. So that gets us under the periodic method, the $8,478 worth of ending inventory. Under the perpetual ending inventory system, we've got to take those 80 units at the $60.80, add the 20 that are there from the 62.80, and then add the 60 that are there from all the way back at the very beginning of that $50.80, right? All the way back there. So that gets us 9,168 of ending inventory. Now, how about now? Once again, I copied the slide so that I didn't have to toggle way back to get you way dizzy. So under the weighted average cost method, under both perpetual and periodic, really all we're doing is taking a weighted average cost per unit, and then we're going to use that to identify the cost of sales. And once again, we have to be sensitive between perpetual and periodic. So under the periodic method, I always think this one is easier. So let's do this one first. We're going to take those 90 units at the original $50.80, then the 220 at the 55.80, right? Then the 80 at the 60.80 cents, and the 140 at the 62.80. So let me just go back. So that's really just all that stuff right there in the middle column. And then we're going to divide by 530 units because that's how many we produce. So that gets us 57.55 as a periodic weighted average cost per unit. Now, what we need to do under the perpetual method is we need to go all the way back to those 90 units at 50.80 and add the 220 units at 55.80, and we're going to divide those by the 310 because that's how many that were available for sale. So that gives me 54.35 per unit during that time period. And then we do the same thing after that time period, and we get a weighted average cost per unit of $60.45. And so you'll see when you move down to the bottom part of that slide under the periodic, the cost of sales, what did we sell? We sold 370 at an average cost of $57.55. So that gives us cost of sales of $21,293. But then under the perpetual, we have to assign those 250 units a specific cost, and then the final 120 units a specific cost. Of course, the earlier ones are at the lower cost, and the later ones are at the higher cost. And so that gives us cost of sales initially with that first sale of $13,587, and then the second sale $72.50, which then leads to different gross profits. Once again, there's that $32,946 in terms of sales, and so notice that the gross profit $12,108 under perpetual, $11,652 under the periodic. And then the ending inventory, this is an easy calculation, so you just multiply ending inventory, right? Because you just have 160 units at the 60.42, and we have 160 units at the 57.55. Boy, that was a lot of math there, and we did a lot of math there because note that the LOS reads calculate and compare. So that's a really good example. And I encourage you guys to pause the video if you need to go back and make sure that you do all the math correctly, because the LOS does read calculate, and so that means that you might have to calculate it. But I think just as important is, hey, how do we deal with these different valuation methods under different input price assumptions? I mean, what do we know? We know that inventory unit costs can either be declining or rising. And so note that I have two slides here back to back. I think it's best to go ahead and take a screenshot of these two, put it on your phone so that you have these things so that you can just look at these and remind yourself of these. These are good memorization items. And of course, these things should make perfect sense. The more you go over this, the more sense that the difference in the valuation methods will make to you. So if we have declining inventory unit costs and constant or increasing inventory quantities, then under FIFO, we're going to have a higher amount allocated to the cost of sales. That makes sense, which means that profits will be lower, but also tax liability will be lower. And then just the opposite will happen with LIFO. And then the next slide indicates that under rising inventory unit costs, so if the price of our inputs are going up over time, then FIFO will result in higher profits and higher tax liabilities, and LIFO will result in lower profits and lower tax liabilities. Now, how about ending inventory? Let's focus on that far right column. If we're doing FIFO, if we're assuming the FIFO valuation method, then what that means is that the first ones in are the first ones out, which means that the ending inventory is going to very closely, if not perfectly, match the replacement value of the inventories. Because remember, maybe we manufactured or maybe we bought those today, and so those reflect current pricing rather than something that we bought a month ago or 2 months ago or maybe even 6 months ago. The LIFO ending inventory amounts, however, are not reflective of that current replacement value. So that's important. Remember that. Now I have another example here. Two companies, they're identical in every way except one uses LIFO, one uses FIFO. And some simple assumptions here about operations is that these companies maintain inventories of 1,200 units per year. And each year the number of units purchased is equal to the number of units sold. Unit sales increased by 8%, so we're selling 8% more. And the selling price increased by 3%. So we have inflation on both ends there. And we're told that $12 is the selling price and the purchase price of the inventory is $8. And so we can go through and quickly calculate ending inventory here under LIFO. All we've got to do is take that 1,200 times the 8 because those are the original 8, so that's not going to change. But under FIFO, we need to compound this out, right? So we're compounding it out at the 3% for 1 year and then the 3% for 2 years. So that gets us 9,600 in year 1 and then 9,888 in year 2 and 10,185, which is very different from Company A, which is 9,600 for each year. Now, the sales under both LIFO and FIFO, they'll be identical. And so I don't need to spend too much time on this slide. Feel free to pause it if you need to. But then cost of goods sold, and this is pretty much the math that we just did on those previous tables, but it's important to note that under LIFO, those cost of goods sold go from 80,000 to 88,992 and then to 98,995. But under FIFO, those cost of goods sold do not rise as quickly to reflect the difference in the sense that in the first in, first out, we're selling those older units. Now here's the important slide. So go back over the math if you need to, but here's the important slide. As a financial analyst, take a look at the subtle differences between and among these different accounts that we've been studying for the last few minutes. So note in year 1, in year one, everything's identical because nothing changes. And then it's only in year two that we start making these changing assumptions. And so ending inventory is different. And that means cost of sales is going to be different. And then gross profit is going to be different. Wow, what that does is that has implications, especially for the inventory turnover ratios. And so I think this is the more important sense of this LOS, is to consider the differences between LIFO and FIFO, and then know what impact those differences will have on various financial ratios, in particular inventory turnover ratio. How about this LOS? Explain the LIFO reserve and LIFO liquidation. So in the first slide, we'll do the LIFO reserve. And remember that we have the LIFO reserve because some firms use FIFO, and there's going to be a difference between those two. And so we need to make certain that there is an amount that shows the difference between the reported LIFO inventory carrying amount and the inventory amount that would have been reported if the FIFO method had been used. And so really it's just a simple mathematical subtraction of FIFO inventory minus the LIFO inventory value. And it has some implications. So during periods of rising costs, the inventory carrying amounts under FIFO will be higher than under LIFO. And if the number of inventory units manufactured or purchased exceeds the number sold, that LIFO reserve is going to increase because of those extra LIFO layers. And that brings us to a LIFO liquidation. And this is a scenario under which firms that use LIFO have the number of units sold exceeds the number of units that are purchased or manufactured during that period. So I want you to think of it this way. Let's suppose that we have a company that has a cost of goods sold of, let's say, $10. And this firm is able to sell their units at $100. Okay, so think about this. It's costing $10 and they're selling at $100. So they do the 100 minus the 10 to determine profitability and the tax liability. All right, so they do that for a while. And then let's suppose, just for some crazy reason, that the input prices spike and they go up to $80. Now remember, under LIFO, we're assuming last in are the first out. So we are now assuming that we're selling those units that cost us $80. And so let's suppose we do that for a while. So now we're doing 100 minus the 80, and we're paying lower tax liability, and we're paying and we're showing lower profitability, right? Now let's suppose we do that for a while, and we wipe out all of those units that we sold that cost us $80, and we have to dip back in to those that cost us $10. So all of a sudden, we have a tremendous increase in taxable income and a tremendous increase in our tax liability, and maybe even some positive cash flow results. And so think about this LIFO liquidation as just kind of wiping out an entire layer, which of course during rising prices are going to have a higher input price, a higher cost of goods sold, right? And then you go back to the earlier ones that have the lower cost. And so look at the middle of the slide. Here's the important thing. Major effect on financial statements includes an increase in gross profits, right? If the unit costs have been rising. It's one time probably. It's probably not going to happen for a long time period, not sustainable. How about this LOS? Convert a company's reported financial statements from LIFO to FIFO for the purposes of comparison. All right, so here's a good formula for you to memorize. Another one, start with the reported LIFO inventory and then just add the LIFO reserve. Now, the reason that we're doing this is so that we can make a comparison. Remember that US GAAP allows for both of these. So clearly we're going to run into a scenario where we're comparing two competitors, and one's going to use LIFO and one's going to use FIFO. And if we're concerned about the liquidity position of both, we want to calculate some liquidity ratios like the current ratio, and these two companies are using different valuation methods. Well, we need to make that conversion so that we can compute a fair current ratio between these two companies. And of course, there are other implications at the middle of the income statement and of course on the bottom of the income statement. How about measuring inventory at the lower of the cost, which is, the input price, the input cost of the inventory, and the net realizable value. Net realizable value meaning, okay, if we sell it, how much can we realize? And so under the international standards, inventories may be measured and carried at the lower of the cost or the net realizable value. Now, when would the net realizable value be less than the cost of the inventory? And that's the case when a firm is carrying inventory that nobody wants, right? That nobody wants, or alternatively, maybe there's a giant spike in some of those input prices. Now, the inventory carrying amount must be written down to its net realizable value. And this loss is recognized as an expense. So that makes sense. If we're making stuff that nobody wants and we can't even recover our inventory costs, then we need to recognize our asset at that net realizable value. Now, under the International Financial Reporting Standards, we can reverse this. If for some reason that net realizable value then improves and increases on top of the cost of the inventory, then a reversal is allowed. Under GAAP, there is no reversal of those write-downs. Now, the lower of the cost or market value under the GAAP defines market value as the current replacement cost, and that is plus or minus some upper limit or lower limit. So think of it as kind of a confidence interval that we talked about back in the old quantitative methods days. How about implications for financial statements and ratios? Under the international standards, if the value of the inventory declines below the carrying amount, then it must be written down to its net realizable value, and that loss is recognized as an expense. It's generally going to be reflected on the income statement in the cost of goods sold, and the write-down reduces profitability, of course, and the carrying amount of the inventory on the balance sheet. I mean, that makes perfect sense that if our inventory is worth less, that's two words, not worthless, but worth less, well, then we have to show that on the balance sheet. And then inventory turnover and total asset turnover will be positively affected because that asset base is reduced. Net profit margin and gross profit margin, on the other hand, will be lower. What about disclosures relating to inventories? And so these are pretty similar under the international and the U.S. standards. Accounting policies that are adopted must be disclosed, including any formulas, carrying amounts and classifications, and carried at fair value. Yeah, that's all good stuff. Explain the issues that analysts should consider when examining a company's inventory disclosures and other sources of information. What kind of conclusions can we make? So the choice of inventory valuation is significant. I mean, it's going to affect things like current assets, of course. It's going to affect things like revenues minus cost of goods sold. Now, not the revenues, but it's going to affect the cost of goods sold. So that has implications for profits in the middle of the income statement, and also profits in the bottom of the income statement. And then it's going to affect ROA and profit margin. And of course, it's going to affect inventory turnover. And so what's important is to make certain that when you're computing and evaluating these ratios, do it over a trend analysis, do it over time, and make certain that you're aware of what's implicit in the trend and what impact the choice of valuation method has on that trend. Now, some firms, of course, going back to my motorcycle example, if Harley Davidson goes from just, pieces of sheet metal here to turning it into handlebars and turning it into a gas tank, and then all the way at the end, it's a finished product, what happens is that increases in finished goods and the work in progress, that indicates an expectation that we're going to sell a lot more motorcycles on the other hand. Now, you have to balance that with if there are lots of finished goods, it might mean that there's going to be an increase in the cost of storing and handling that inventory. All right, so let's make sure that we know growth rate of finished goods and the growth rate in its sales. If there's a really good or really high correlation with what's going on the top left of the balance sheet with the top right of the income statement, then that's an indication of steady sales. Remember, in other videos, we've talked about the quality of earnings or earnings quality. Well, this is one way to kind of determine if those earnings at the bottom of the income statement can be sustained by looking at the relationship between the finished goods, growth rate in finished goods, and the growth rate in sales. And of course, this has implications for things like the management and the discussion and analysis and the management thoughts and all the stuff that management thinks about those financial statements is going to be in that management discussion and analysis and can be pretty revealing. I wonder if I convinced any of you that this was fascinating, but surely I convinced you that this was at least interesting from a financial analyst perspective. So next up are those long-lived assets.